Hello traders, welcome to the next section of Vwap. I know the theory was incredibly heavy and I know it says theory right at the top, and I don't want you to get worried and think, oh my god, more theory. What it is basically I was reviewing the theory section, and I just wanted to make sure that everything that I wanted to say came across, and I was pretty happy with it, to be honest. On reflection, I think I covered everything I wanted to. Um, but what it is it's really important that you understand, how do institutional investors actually use VWAP to trade. And what I realized is a golden opportunity for me to show you that, but also to solidify and summarize some of the things that I was saying in the sort of theory section, just to make sure that everyone got it and understood it. So I'm kind of just going to combine those things together very quickly, but this is very much a task section. You'll be glad to know. I want you on the charts. I want you after this to be doing some things, and it's really going to help you understand what I'm trying to convey. And again, I just want to say, and I know I said it before, look, I understand, right, the theory in the previous section, it was heavy. Some of you probably understand probability distributions and you might have got it fairly well. But those of you that don't, I don't want you to be disheartened and think a lot of maths going on and too much statistics and this and that. It's not, all right? Same as I said in the stage one probability section. Guys, just get the gist of it. That's all. Just don't use it as a pure indicator. That's all. And I meant that when I said the maths. You don't need to understand it to a deep stage. It's obviously important for completion that I show it here, but as long as you get the gist of it. So that's why I thought when I was reviewing it, I realized, it was quite detailed and in depth. I thought, let me just summarize things. And as long as you take away about 90% of what I'm going to say, you'll be all right. Just don't take away like 10% and just treat it as some lines and Envy says this is what I've got to do, so I've got to do it. Try and um, really get a feel for what the VWAP is telling us, um, because that's going to benefit you. And look, the final thing I'll say is, and I don't want to keep repeating the point, is that, and I said it before, if you don't get it straight away, it's fine. It's something I want and expect you to develop over time. Okay, so the reason I'm saying all of this, where I'm going over some of the statistics and the maths, is just because when you're actually on the charts over the next few months, this is where I want you to end up. It's not necessarily where I want you to be by the end of this module. Even if you get 5-10% of it right now and you work towards getting a larger chunk of it, 90% or whatever, over the next few months, brilliant result. That's all I'm saying. Keep revisiting this. Just don't obviously fall into the trap, as I keep saying, of just treating it as a indicator, and hopefully over time, um, you'll be able to develop the same understanding that I've been fortunate enough to develop. And like I said, at the end of the day, this is the honest truth. When I was taught this stuff in an institution, it just wasn't explained. And this is one of the top institutions in the world, two of them. This was not explained to me in this way. They just assumed, I think, that um, maybe I knew it somehow or whatever. But I'll be honest with you. Um, you may think this is far-fetched, but honestly, it's true. I don't even think a lot of institutional investors or traders around me really understood this properly. Um, and they were kind of winging it. So, at the end of the day, that's why I say, even if you don't get 100% of what I'm talking about, you're okay. But try to get at least 70, 80, 90% over the next few months. So you can really understand, and it will help you. You can understand what VWAP is. So, I already said the VWAP, essentially, it is volume profile, but it shows the evolution of volume profile. But what I really want to move on to now, and the task, and the thing is, we're obviously going to try and look at how do we use the VWAP to trade. Well, what it is the reason why VWAP is so helpful, and I've talked about it being intra-period, is it's really showing us how the profile is developing throughout the day. And what that does is it helps us identify um, people in industry and in the market profile books I told you guys to read about. They do call it day types, and that's okay. There's nothing wrong with that. It's actually pretty fair reflection. That VWAP will help you determine the day type. So if you think about it, it's really useful because it can give you clues as to, are we going to be in a balanced day today? Are we going to be in a, I call it imbalanced, obviously, as you know, but if you look, I'm going to start to introduce the word trend here, but be very careful. You know, I've mentioned it before. I don't mean it trend in the way of retail. I actually mean it imbalanced, as in value is moving away from current fair value and we're seeking it elsewhere. But it's such a mouthful for me to keep saying that. I'm happy to use that word trend because ultimately it's just the market is obviously moving away from balance. So, and as you'll see, I've talked about rhythm and acceptance, right? And this is very much part of context. And you'll see when we talk about weekly, monthly, quarterly, yearly VWAP, this is going to be absolutely crucial because you're going to see as the week develops, the month develops, the quarter develops, the year develops. We want to be able to see what's the market condition year to date, month to date, quarter to date. And I'll tell you why that is obviously because of different types of investors, etc. And we'll get into that because obviously everyone's got different perceptions of value. The reason I mention that here is because what I show you here about day types, you see, it's called day types, but the reality is the reason I don't like that word is because it is so applicable to the week, the month, the quarter, the year. Why call it a day type? It's more just type. That's all it is. It's rhythm. I like to call it what's the rhythm, the market condition. That's what I prefer to call it. So I'm going to write it here, market condition, and then combined with the rhythm. Okay, and this will make more sense as we go along. Market condition I've already talked to you about, balance or imbalance. So that is essentially, we can call it the day type. People call it day type when they're talking about day VWAP, but like I said, it can apply to the week. Is the week balanced or imbalanced? See, we call it week type rather than call it week type, month type, whatever. Just like to call it the market condition for the week, for the day, for the month. So you can use these words interchangeably. Rhythm is also something I'm going to introduce here because I talked about acceptance and rhythm. Rhythm is absolutely crucial because I want you to develop an understanding of rhythm, again, on the day, the week, the month, the quarter, the year. And the reason I'm mentioning all of this again is because basically everything I show you here, it's going to apply to the weekly VWAP, to the monthly VWAP, quarterly, yearly. We don't look at them that differently. Essentially, we're going to look at them in the same way that I'm about to show you. So basically, I've talked a lot, but it was important. I said all of that because I want you to get a feel for what I'm going to be talking about in this section and ultimately what understanding I want you to develop in the task. So, like I said, what I want to do is I just want to quickly solidify some of the things we said in the last section and just make sure that it was well understood. Now, what it is I'm going to approach it from a point of view of how do we actually use this thing to take positions and actually think about opportunity, right? So what it is the VWAP, as I explained in the last section, is telling us the mean, right? So over here, okay, in a perfect distribution, which isn't always going to be the case, let's say that's going to be the VWAP, but that's not where we actually started the day, right? This is the end profile. This is almost like a previous day's profile, a previous month's profile, a composite profile, or whatever. Actually, what's happening, as I said, is the profile is developing throughout the day. So here we're seeing a balanced day. In a balanced day, what typically happens? Well, a balanced day follows a sort of a balanced distribution, and we saw this with the heights of males and all the stuff we were talking about in 1.4. So essentially what's happening is early on in the day, right, we're going to start off almost in a balanced state like that. And the mean is going to be there, right? We can almost say that's the VWAP. Then as the day develops, and you'll see more trades come in. What is happening here? Market orders. Can you see we're just building on top of that? Where's the next VWAP going to be? It's going to be in around the same area. Then we're building as more. Do you see it's a balanced day? Then we get more, right? Now we can split this out into, initially it looks like that, then we get more volume, then we get more volume. Do you see? Rather than me having the VWAP there, VWAP there, VWAP there, and having to see all three, and at the end of the day, I could keep drawing I could have hundreds of these going side by side. Like I said, it will take up my whole screen. It's not realistic. I want to see how did this develop throughout the day. Let me just take one measure with obviously the standard deviation, which I'm going to come back to in a second, and just join it up. So that's what's happening. As the profile is, you see more volume builds, then we get, it's almost developing like that throughout the day. So there's going to be a VWAP for every one of these, isn't there? And actually what's happening is we just join them up and it's very flat throughout the day. So you have that. And as this thing is obviously developing throughout the day, you're going to get the VWAP in the middle, aren't you? So more and more volume is building, and ultimately through time, as market orders come in, the VWAP is just going to stay flat. Okay, so essentially what are we saying? Well, we're saying more than likely, because do you see what the VWAP allows us to do is it allows us to predict what type of day or week or month or year we're likely to have. Because if at the start of the day the VWAP is pretty flat, we already know that price is just doing this, right? So it's not in a trend is my point. It's not imbalanced. It's very balanced. Okay, so what did we actually say? And in fact, let me just redraw that, apologize. So I can just match it to obviously what you see here. We talked about this during auction market theory, and the market is very balanced, right? What did we say in the probability distribution section? We said that one standard deviation, right, is just a measure of spread, where we obviously did the variances, and then we average them, and then obviously we square root them, etc. I don't want to get into the maths too much, but obviously I did ask you to watch 1.4 again, and I showed you how it's done to get one standard deviation. What that tells us is what? About 68%, but let's just round it up, about 70% of market orders fell within one standard deviation. Okay, now one thing that I've kind of briefly mentioned, but I'm just going to tell you here is all institutional investors, they're looking at one standard deviation, but they're also looking at two standard deviations. And I'll explain why that is because basically all the second standard deviation tells us is, so we calculate one standard deviation, right, either side of the mean, we multiply it by 2. What that does is it captures more of the data, and actually statistically all it does is it captures approximately, and I mentioned this in the last section, 2 standard deviation, 95%. And look, I understand some of you, not through any fault of your own, because it might be new to you. You're gonna obviously be thinking, oh my god, this is a lot. Maybe you are, maybe you're not. Look, don't worry about it. At the start of my career, even though I was a mathematician, for me to understand this in relation to markets and how markets were moving, like I said, I tried to be very perfect. So I had my sort of pitfalls that I fell into too. And it took me a long time. to understand this properly. So don't worry, I don't want you to necessarily get this straight away. I want to use this as a reference. So over the next few months you're trading the VWAP, I want you to really develop the understanding from this point of view that, okay, I understand now why investors are using the second standard deviation, because 95% of all data, market orders, heights, whatever it is, falls within the second standard deviation band. And I'm going to show you that in a second. Don't worry, we're going to get very practical in a moment, and this will make a lot of sense. But it's important I say this about the second standard deviation, because I don't want anyone to wonder and think, why are we using the second standard deviation band? I don't understand that. Basically, it's because 95% of the data, approximately, falls into here. What does that mean? That means that approximately 2.5% of the data falls outside of the, let me redraw that, falls outside of the band, the second standard deviation band, and 2.5% here, right? 2.5 plus 2.5 is 5, and then 95 is 100%. So my point is this: in a balanced environment where we have a nice shape, and we talked a lot about the shape, what's the probability of the market essentially printing market orders here? Peanuts, guys, 2.5%. What's the probability of the market sustaining a move in this region in a balanced environment? Guys, 2.5%. Why is that? Because only, not historically, but up until, well, it is historically, right? Up until that moment in time. So here, let's say you're at this moment in time. How much of the data has actually fallen in this region? 2.5%. So it's just the probability based on observations. And here, 2.5%. So can you see, basically, when this is happening, do I really want to be trading here? No, I don't. Because the chance of me staying within this region is very high. Do I want to be trading here? Yes, I do. Because the chance of me staying in this region is very low. There's barely any chance, based on all market orders up to that point, that I'm going to stay in this region for very long, right? There's a 2.5% chance. Those are good odds. I want to take those odds. I'm sure you do. So that's why people, when we go outside of the second standard deviation in a balanced environment, algorithms are fading it, fading it, fading it, fading it, fading it, fading it, okay? Why? Because probability is on their side. Why would you take a breakout trade in this environment, balanced environment? It's completely crazy. Because what's the chances, statistically anyway, based on market orders to that point, of this going in your favor? 2.5%. Would you rather take a 97.5% probability? You know, you hear a lot about guys talk about high probability trades. And I know I obviously do dismiss retail talk a lot. It's complete garbage, guys. Can you see this is what probability trading means? You know, it's like either you're taking a very high probability trade of reversion. Do you remember we did this on the volume profile in foundation course, where I said, oh, you know, we saw absorption and we saw heavy selling coming in this region, and I said, oh, I'm playing it back to the mean, to the VPOC, to the whatever, to the Vwap. I didn't call it the Vwap at the time. Can you see, guys? It's no different. You've been doing this in the foundation. Obviously, just didn't want to get into the statistics because it obviously would have been a lot, moving too fast. Now you're ready. You're in the pro section. We're moving you on. I want you to understand why I was fading the market. And remember, you saw this. Just don't get, this is my point, don't get thrown off just because it's a normal distribution and it's got all these percentages and stats, and don't worry too much about that, all right? We're not looking to become mathematicians. However, I have to be honest with you that obviously you're now an institutional investor. You will need to just have a very basic grasp of, don't just do things randomly, is my point, just because, oh, Envy told us to do this. No, I've always said question everything, have a basic understanding, and I hope this has given you a good understanding of why on a balanced day you're fading the typically the extremes which are defined as the second standard deviation. And we can talk a little bit about rhythm. Obviously we can see if the market keeps bumping its head just below, just below, just below, then it's okay. The rhythm then has changed. It's no longer the second standard deviation, and we can talk a little bit about that. But I just want you to understand that in probability terms, why so many institutional investors and algorithms and so on and so forth are looking at standard deviations, because it tells them in a balanced day, you know, I told you the standard deviation has this amazing property, but it's accurate when we have a balanced environment. And I talked a lot about this in 1.4 again. So you'll see why this can become a problem when we have an imbalanced day, because when we have an imbalanced day, what did I say? Market orders, you don't act like this, do you? You start to build volume at an edge, and what happens? Do you see this area starts to build volume, and it no longer stays this shape? You start to get out of shape, and therefore you can't, these probabilities start changing. That's the problem, and we'll talk a little bit about that. But you know, again, I don't want you to be misled and think, oh my god, I need to understand this mathematics to a high level. You don't. Look, at the end of the day, just get the gist of it, that okay, within the first standard deviation is 70% is fair value, so obviously I can use that accordingly to decide if I'm going balanced, imbalanced, as I showed you in the market condition section. But in terms of fading the market, I've got a very high probability if I go even out further, because the second standard deviation captures what? I mean, first standard deviation is 70%. If I obviously look to increase the distance, and you saw this, the number of heights, the data, of course, in a bigger region, is going to be captured 95% of the data. All that means is there's a 95% probability. It's not guaranteed, but it's the best model we have of the world. Remember, I said it's by no means perfect, but it gives us a very good idea that more than likely going forward, because of what we've seen in the past, over the day, over the week, over the month, there's a 2.5% chance that we're going to stay in this region. Why is that? Because 95% of everything happened within the bands, okay? So obviously it's 2.5% this side, and it's 2.5% this side, all right? So essentially, hopefully that makes sense. Let's look at this as we would on an actual chart. All right, so let's go to the next slide, and then hopefully this will make a lot more sense to you. Okay, so now you can see this is actually crude oil. It's the actual crude oil chart. Don't worry about the color of these things. I'm going to talk about them. They're these Heikin-Ashi candles. I don't use them, but I'm going to get you guys using them. They're going to be really helpful to you to visualize rhythm, and I used to use them a lot historically, because they, not because they have any magical properties, I really couldn't care less about any of that stuff. There's various reasons why I found these type of candles useful, and you know, obviously I'm trying to help you out, guys out. But now I don't use them. I don't even use candlesticks. I use just black lines, because obviously my understanding of rhythm has become obviously much more advanced over the years. But I think this will help you to develop an understanding. It will help you get into trades, and we'll talk more about that. My point is, don't worry too much about you know, the colors of these candles and stuff like that. Just notice how similar this is to what I was saying theoretically. Okay, so this is the actual crude oil market recently, and essentially it's just going up and down, right? Can you see? It's a balanced day, guys. Look at the profile. But the profile didn't look at that like that at the start of the day. Do you agree? The profile, we talked a bit about this in the last section, probably looked more like that. And at some stage, obviously we can see how the VWAP changed. Can you see it barely changed? Early on in the day, obviously a lot of market orders are coming in, and there's not much data, so it's going to be a bit volatile. But as things settle down very early on, look what happened. Okay, all that means is that the profile, as new orders came in, yeah, we had a few orders here, but not many. As soon as we came down here, it just moved up very quickly, and we started building much more here, much more here. So yeah, can you see we had some market orders increasing on this side, but generally the bulk of it was here. And then here again. Do you see the market just never went anywhere? Okay. So essentially, what have we got here? The second standard deviation is basically this area here. Can you see that is the second standard deviation? Okay. So what algorithm's doing early on in the day, they're establishing, say at this point, they'll know. Obviously, you won't be able to see all of this, but it's like that, right? So can you see the VWAP went up and then it came down? What does that tell us? Probably that, yeah, early on in the day we built some market orders here, but then we came down and we had a nice balanced profile. But what happened? Early on in the day the VWAP was there and then it shifted down as this came in and then it evened out, right? So you can see that there. That's why the VWAP is so useful. Because think about it, otherwise I would need to see this profile split out at that period, which is probably that bit. This, can you see that? This period here was probably that bit. This period here, then I need a separate profile with sort of both of them combined. Then I need it for when this part of the day happens. So I need a third profile. Can you see? How many profiles can you practically have? For me to know that the VWAP what? Probably at some stage was up here, then it moved down here, then it probably moved down here at one stage, which you can see here, and then it balanced out. And then the more we built market orders in the middle, balanced out. So it may have obviously early on fluctuated and then done this kind of thing. Can you see that? Same shape. But rather than me having to see so many different profiles, the VWAP just allows me to kind of see how the evolution of the day was happening. So I can make a prediction on, well, we've got a flat VWAP and we're just going around it, as in the profile's just building on a very balanced level. How should I trade this? And I'm not going to trade it as an imbalance, because it's not imbalanced. It's very balanced, isn't it? We already said the fair value, the one standard deviation. So what am I going to do? I'm going to look at the second standard deviation, which we actually have for us here. I'm going to take short positions, long positions. You see, this is where the rhythm comes in. And look, the task for you, just so you know, is you're not going to be listening to me and then that's it. We move on and talk more. No, your task is going to be identifying this on the real market. Okay, we're going to do it together, and then I want you to go away and do it. So it's very important that you understand this. Not only a market condition, balance, imbalance. Obviously, this is very balanced, but rhythm. What's the rhythm at the start of the day? Second standard deviation, second standard deviation, second standard deviation. Look, it changes. Something changes. You need to be able to identify. I talked a lot about this in the composite section where I said, guys, we have major edge over algorithms when we can start to apply logic, do things from a discretionary basis. I tell you, it's going to be difficult for an algorithm to identify these type of conditions in the way we can, almost a little bit from an analytical perspective. Obviously, where it's clearly obvious, they should be able to identify it. But at the same time, it's like, look here, I'll give you a good example, is we have massive edge because when you program a system, what do you say to it? Do you say, oh, when you touch the second standard deviation, I want you to consider that a reversion when you're a bit of a price away from it? Do you see what I mean? We can use a bit of logic and just say, well, what's the rhythm of the market? approximately. Right, those two were obvious, but look, it didn't quite touch it, but it's obvious. Pretty much at the second standard deviation, right? And here we can say, do you know what? We're starting to build a bit of volume here, right? Which you can see here. Maybe this market's not interested in actually going here. The rhythm's changing, okay? And then we revert back to second standard deviation. So my point is, we need to be aware at all times of day. I mean, to be fair, this would have been a much better example had, imagine that hadn't happened and the market just stopped in that region and turned around. That's why I say sometimes you got to understand the rhythm of the market, because in that scenario, you're having the rhythm as 2SD, 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 and then look, one first standard deviation, first standard deviation, first standard deviation, and back. So whilst okay, we overstretched in this circumstance, I just wanted you to see why I'm saying we need to kind of think about what's the rhythm of the balanced day. So imagine this price wasn't here. So my point is this, and imagine we were just doing this. I hope that's clearer what I'm trying to get at. Can you see the rhythm here is 1 SD? You see that? Whereas if we're doing pretty much what we've been doing on this day, I'm just going to draw it in myself. Can you see that? Different rhythm, guys. Second standard deviation, second standard deviation, second standard deviation. You know, in the market, and you'll notice this, the market has this rhythm to it. See, I've heard some guys, the way I was taught, rhythm in institutions was more about, you know, the size of this leg and then the side, comparing it, and even when we're going up like this, this leg should match that leg, should match that leg, and then retracement will be similar. And yeah, it's kind of useful, but I think a much better way of looking at rhythm is more in terms of the rhythm versus you know, the standard deviations and the Vwap, because I told you how powerful this thing is. It helps you to see how the day is developing, gives you massive clues and amazing trading opportunities. So if the rhythm is 2SD, we can look for fading opportunities. Okay, so we're going to do this, and actually don't worry, I've summarized all of this in a table for you, which you're going to see, which I call like a summary and a trade plan and whatever. So I've got all of this summarized. But look, at the end of the day, I just wanted you to see how institutions are approaching this, and a lot of algorithms are programmed to do this, to identify, is the VWAP flat? Okay, let's fade, let's fade, let's fade. Because what you'll see is when this fade fails, so let's say you build here and then obviously the profile shape starts to build here and we start to go imbalanced outside of the first standard deviation, and we start to build here, guys, it will pop, because a lot of algorithms and obviously locals, day traders, intraday investors, they'll be fading this market, and obviously they'll be bailing. So you know, that just goes to show how many people are using this type of analysis in institutions. So look, I think I've pretty much showed you what a balanced day looks like and why the VWAP is so powerful, because it's a good way of identifying a balanced day, a balanced week, a balanced month, a balanced year, and thinking about how can we trade this. Where's investors' perception of value? Well, it's clearly very centralized. So every time it goes out, they're going to go back to this fair value. And like I said, we've kind of done this already in the foundation section. We just didn't do it from a probability perspective, and also from a sort of developing value perspective. We kind of did, but we did it very much on the depth of market, and you didn't actually see any way of how the profile had developed over time, and that gives you clues as to not only how the next few minutes or hour may develop, like we saw in the depth of market, guys, how the whole rest of the week or the whole day or the month or the year will develop. So you'll see this, and the reason I keep saying this again and again is because when you see I go to do this on the week, month, year, and I introduce all of that to you, I'm not going to go through all of this again, all right? Because it's exactly the same. Obviously, I'm going to talk about balanced weeks, balanced months, but I'm not going to go through probability distributions and show you all of the stuff because I'm just going to assume you know it, obviously, because like I said, this applies to all types of VWAP analysis, okay? So let's move on to imbalanced days, theoretically and then in practice. Okay, so on an imbalanced day, let's just think about what's actually happening here. So on a balanced day, right, what's happening in the market? It's just obviously gyrating up and down, and market orders are developing, right? Again, you've seen this on the depth of market, nothing new. But what happens when you go imbalanced is you no longer within this fair value zone, right? And you start to do what? You can call it a breakout if you want. This is a true breakout where you start to build some market orders, buy market orders, get imbalanced, and you start to do this type of action. And you may just mess around here or whatever. But the point is, something's changed, right? Now, can you see what's happening here? Market orders. What's going to happen? You're going to develop volume in this region, okay? Can you see? Here you're going to have volume, here you're going to start getting volume building. And it could actually get quite thick around here. If you keep trading here, I know it's a terrible drawing, but you understand what I'm saying, right? The point is you're going to build a lot of volume. Something's changed, right? So you could, in theory, end up building a lot of volume in this region. And in fact, ultimately, you could even go on to build tons of volume. So my point is, look at the shape of this distribution now. You no longer, so all of this is filled up with volume. Can you see? Guys, you can't use the same probabilities. It doesn't work anymore. You no longer got a 2.5% chance up here, right? It's completely changed. In fact, your probabilities have shifted in the favor of going imbalanced, because now all of a sudden your distribution has done what? The mean, do you remember this? I talked about it. The Vwap has shifted up here. So you've almost got an entirely new distribution, okay? So this distribution almost becomes like that. Can you see that? You've gone imbalanced. You're building market orders. There's a whole lump of volume being built up here. So my point is, the distribution changes. All of these probabilities shift to this side, to the point where you can no longer say that I have a high probability. Because look, you're not. At the end of the day, this is why I say, look, you don't need to be a mathematician to get this. Think about it. If the price is just going up and down like that, you can just logically tell, all right, do you know what? Price has been going up and down. Pretty good chance it's going to stay going up and down. If something goes like that and then it starts to do this, it's not the same, is it? Something has changed. This is almost shifted, almost entirely. Obviously, your balance distribution is now more like, do you see? It's completely changed. It's completely changed. Different kettle of fish, imbalanced day. Now, I talked about this a little bit in the theory section where I said, obviously we have different types of imbalance, and this comes down to rhythm again. Do you remember in the balance section, I just talked about it, sorry, a couple of slides ago, or one or two slides ago, where I said, if the market's moving like, close to the second standard deviation, we can say we'll fade the 2SD because the rhythm is a second standard deviation rhythm. Obviously, I said, and I'm not going to draw it again, but obviously, in fact, let's just draw it just for completion. if we've got the market doing this, it's not a second standard deviation rhythm, is it? And we shouldn't expect it to be. It's a first standard deviation rhythm. Guys, it's exactly the same. When you go imbalanced, right? So, you know, we've said, let's say the market just starts off in a nice balance, and then something changes and we start to build volume. Okay, guys, you can either build volume. Let me just do this again. You'll see why I'm doing this again. So you, in a nice balance, something changes. You can either build volume here. Do you remember we said new heights come in or whatever, and some data comes in this region, right? Just above the first standard deviation. The alternative is what? You could be in, let's just say you're in this same balance day, right? You don't have to build it here. You might build it here. Can you see? You're either going to have a lump there, or you're going to have a lump of market orders there. It's different. The rhythm's different. In this stage, the rhythm is very much a one standard deviation imbalance, which I like to call a normal trend, right? I do like to use that word just because I find it quite useful to distinguish between rhythm and pace of I mean, I could like to call it imbalance, but in terms of when I like to identify rhythm in terms of imbalance, I like to call it different types of trend. I don't know why, it's just always stuck. Well, I call it normal trend, slow trend, or fast trend. So I don't know. I think basically in one of my early days in the prop firm, someone had mentioned it to me as that, and I don't know, it's always just stuck in my mind. I kind of like that term, kind of normal trend, fast trend, and then slow trend is here, basically, where you're doing this, but then you start to develop balance, very much in this Vwap region, basically, which is the Vwap here. So can you see, you're either developing it here, you're developing value here, you're going imbalanced here. Do you see the transition period can start in different regions? What it is the reason I like using this slow, fast, and normal trend is because it helps me identify trading opportunities. And I'm going to show you that when I'm taking trades, depending on obviously how the rhythm is, I'm going to basically take it slightly differently. So again, I want you to be careful when I use this word trend. It's not how you think of it in retail trend. It's more seeking value, but in a certain type of rhythm. That's the only reason I like to call it that, because it helps me to identify different rhythms. So this is going to become clear. Let's actually look at this from a practical perspective. Okay, so we looked at this in the last example where I showed you this developing, right? So can you see, you know, sorry about this. Just get the right type of pen. Can you see where we've got almost this first standard deviation, right? And in the early part of the day, we've got what? Some volume here. Now, I know it's not perfectly balanced, but at the end of the day, at this point, we've got fairly good even distribution in sort of this region, something like that, right? It's fairly balanced. Look what happens. We break, and then we don't come back as you would expect in a balanced day. And what happens is the VWAP changes shape. Rather than being flat, like we saw on a balanced day, look what happens. It moves up. Why is it moving up? Market orders. We talked about this in the last section. So do you see what's happening here? Is I'm getting this volume here. You could almost imagine, you know, I talked about this in the last balance section where I said we're getting this volume building here. You see the profile is changed shape. I can no longer use this. I can't use 70% plus this and 95%. Doesn't make sense because now the amount of market orders in the space has changed. It's dramatically increased. Okay, so my probability of staying up here now is much higher. Okay, then the 2.5%, the 5%, or whatever it was, depending on obviously what standard deviation region we're in. So hopefully that's very clear to you that, you know, it's so powerful, this VWAP, and thinking of it correctly, because it can help you identify when we're shifting market condition. And very much here, market condition is within the one standard deviation, right? It's almost like that's the one standard deviation. This is why I don't like to be too precise, because you see it did take a blip below and then it just continued up. But my point is, look, once you've identified that this is happening, and what's the rhythm here? In my opinion, the rhythm is very much I called it a normal trend. We're going to talk about this in a second. But you see, every time it pulls back, I can look for trading opportunities. Yes, pull back a little bit further than I would have liked, but you know, you've got 1, 2, 3 trading opportunities for an imbalance, and all of a sudden we're shifting. The mean is shifting. You know, it was obviously originally here, but it's there as we built, you know, more volume in this region, mean shifted, then we built even more volume, then we built even more volume. So what's happening? The VWAP is moving higher and higher. It's just the average. Obviously, if you've got more orders coming in at higher and higher prices, what's going to happen? The VWAP's just going to shift, and you can see it here. These points are just this point, this point, this point. It's just moving higher and higher and higher. The average of each new profile coming in. Do you see? Otherwise, what would happen is I'd need to literally have all these profiles split out, as I said, on my chart. I wouldn't be able to see it. So instead of doing that, I just have the VWAP. And if you think about it, when all prices on a day are trading above the average, what's happening? Market's moving up. It's pushing the average with it. Every algorithm in the world, I can assure you, given no changes in any other circumstances, because as you know, I do look at other things, just purely on a VWAP basis, guys, they're going to be buying this market. Okay, they're going to be buying this market. They're not going to be playing. Can you see? It just makes no sense to play this as a balanced day, because we're not doing that. We haven't got a flat VWAP. We've got the market being aggressive and clearly telling us, now I'm building value higher. I'm building value higher. I'm building value higher. It's moving up. And that's why the profile isn't that shape, is it? You haven't got a balanced. Look at how the shape of the profile ended up on this day. It almost ended up like a multi-distribution, right? And this is why I did recommend that you read that market profile book, because they'll talk about double distribution days and things like that. I don't really care about that. I care about more what I'm seeing myself. I want to come to that conclusion. I want a book to tell me how I should trade this day. I want to come to the conclusion myself that, oh, we built some value here in the morning. Potentially we could have gone, obviously, in a balanced day, but we didn't. We came out of it. And then rather than returning quickly, you know how I play mean reversion trades? We didn't. The market clearly told us by building volume here in, where was it? Above the first standard deviation. In this region, we actually built frequency, market orders, market orders, market orders. And what happened? That meant we changed shape. Okay? We really changed shape. And in fact, what you can see is we almost just basically built that on its own. So you can see all of this becomes redundant. These probabilities actually moved that way. Okay, much higher probability that we're going to stay up. So you can see in practice, you know, if you don't mind me saying, I think that it's fair for me to say, right? You don't really need to know these specific numbers. I don't care. Like I said, just over time, don't necessarily you know, think, oh my god, Envy gets the maths, so that's why he's, you know, does well as a trader. It isn't. Okay, it's not that I understood the maths better than most guys in the institution, because yeah, I was one of those, you know, to be frank, one of the 1 in 10, 1 in whatever it was that made it in institutional circles. It wasn't because I understood the maths. Because then everyone understood the maths. Okay, it wasn't that. It's just because I kind of got the gist of it. That okay, what's happening here? I don't treat this as some sort of magical line. Actually, I'm thinking, oh, as the gradient is changing, I can see the profile is shifting and the probabilities are moving in my favor, and therefore I'm going to use this very loosely, but I could identify that okay, the market is shifting condition. It's almost like I close my eyes to kind of what this specific line was. It was more, I was almost treating it in an abstract way, and I was just trying to almost be fluid with it and just kind of get a feel for, okay, what's the market doing? Okay, market orders are coming in this region, and therefore my probabilities have shifted, and I've just got a higher sort of chance in terms of if I'm trading this as a imbalance day or a trend day, whatever you want to call it. I don't mind, because I did say when I get the rhythm, I talk about different rhythms. So let's go finally and talk about rhythm. Okay, it's really important on an imbalance day, and I want to just discuss that briefly. Okay, so I want to talk about rhythm, and I did say that I wanted to kind of just solidify, and you'll understand why I did a bit of theory here, because I remember I brought this into the last section. So hopefully now, the way I explain it now, will be much clearer why I did that. Can you see what happens is basically, I said to you, look, at the end of the day, you want to be able to identify different types of rhythms. So can you see here, I've written normal trend, and I said I like to call it normal trend. 1 SD imbalance. So what does that mean? Well, we talked about it in the last section. It's like, am I building market orders above the first standard deviation? So you can see it here. So it's essentially this line. This is the first standard deviation. Can you see we've very much got a first standard deviation rhythm, right? I mean, again, like I said, you've got to be loose with this stuff. This was the problem. I always said people would be like, oh, we got a 1 standard deviation. Oh, it's popped down below and now it's popped back up, and they get thrown off by that. I don't. I just think, well, approximately is good enough. But yeah, we can think of it exactly if you want. Ideally, it would be like that. Can you see that? Bouncing off the area. Can you see the rhythm? So what does that mean? Every time we retrace back to the first standard deviation, I'm going to get long. I'm going to get long. I'm going to get long. Okay? So it's essentially this. But what I do like to do to distinguish between different rhythms is, and it's just a very rough guideline, okay? Don't treat it as gospel. Is, and I have noticed this, some institutions, they do like to look at the 0.5, okay? So all you're doing is you're just putting an increment in there, an increment in there. Because what's going to happen is sometimes the market will have rhythm here, sometimes it 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 will have rhythm on the VWAP itself. And that's what I like to call a slow trend. And don't worry, we'll cover this. I'm going to go through this with you. Very much this region, which is this region here, okay, is a slow trend environment. In fact, I would say even more than that. I would say, so this is the 0.5, okay, that's the VWAP, okay, so this. So actually, anywhere really in kind of this region, okay, so if ignore this, I'm going to just basically go scroll straight over it, but imagine the market was doing this. Can you see how powerful it is for me to identify this? Because if I've identified, oh, the rhythm is what? Slow trend. Slow trend, okay, and that means we're probably building more of a distribution in this region, then I'm going to get long here, long here, long here. Do you see, I'm not going to get long here, because more than likely I'm going to take a bit of drawdown. No, identify the rhythm. This is what I mean by rhythm when I'm talking about rhythm and acceptance on that bullet point in the institutional in the introduction and at the start of every section, where I talk about building hypothesis, context, crucial, guys. When I'm building my hypothesis, I'll be looking at day VWAP, weekly VWAP, monthly VWAP, quarterly, yearly, and I'll be identifying this, okay? Every start of every day, I'll be asking myself, what's the rhythm of the market? On every, I don't like to use the word time frame, it's institutional horizon, really, but let's be honest, it is called the day, the week, the month, the year. It's fine, so you can call it time frame if you want. But I don't want you to think of it in terms of the retail forex chart time frame, all that. No, that's not the true way to look at it. It's to look at it from an institutional investor perspective. What's the rhythm of the market? What sort of retracements or sort of balance to imbalance rhythm are institutional investors using to go and seek value elsewhere? So you can see here in a slow trend, the pullbacks, if you want to call them that, are much deeper. You've got to know that, because you don't want to be entering here. You don't want to be entering here. You want to be entering deeper. Okay, so this is why we granulate this, because ultimately this region is what? It's basically this region here. Okay, so new market orders are building. The profile is changing shape. Okay, still very much changing shape, and you're getting a lot more market orders happening here, and therefore the probabilities are still shifting up towards you being imbalanced, but it's just, where are the market orders happening, so you know where to enter. Okay, 1SD, I like to call it normal, because obviously first standard deviation is considered, quite a apologies, keep getting that, don't I? The first standard deviation is obviously very widely used and quite what people like to think of as normal, fair value. We talked a lot about this. So, and let's look at that. So the first standard deviation is, in an ideal world, it's around approximately that. So if we look at it ideally, you'd be doing this. Can you see why it's so crucial? Once you've identified, you're pulling back to this region, long there, long there, long there, long there, as it pulls back. Okay, do you see that's very different to, and I'm going to basically draw, do you remember before we were getting long here, 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 here? Do you see it's different rhythm? Guys, completely different rhythm. Now, all your market orders are coming in here. They're not coming in here. Okay, so your profile, rather than building volume here, you might build a little bit, but essentially, do you see you're now building a lot of volume in this region? And you can see it here. We built a lot of volume. Profile shape has changed, right? It's no longer normal. It's like that. It's multiple distributions. You're building. Okay. Don't worry, I've summarized all of this for you. That obviously in a trend day or an imbalanced day, week, month, whatever, you'll be looking for trades in a normal trend environment of the first standard deviation. Okay. And then finally, so I hope you can see I'm building you up towards actually taking trades now. In this task, all you're going to do in this task is you're going to identify a lot of this stuff. But finally, and this will make sense, fast trend, what does that mean? So this is why, do you see on a normal distribution, how we've been looking at it so far? We've only had the first standard deviation marked, but you see here, 1.5. I talked about it in the last section. This is why I wanted to do this theory, just to kind of solidify the stuff I was talking about before. Now you're getting market orders here, so the market is very much balancing in this section. Okay, what does that mean? Look how far the mean's going to shift much more. Actually, what's going to happen is, and I forgot to mention this when I was talking about the normal trend, is obviously in a slow trend environment, VWAP's going to be very gradually increasing. In a normal trend environment, VWAP's going to be quite rapidly increasing. In a fast trend environment, why is that? Because market orders are coming in much further away. We talked about this in the last section from the mean. So actually what will happen is you'll be like quite an aggressive VWAP, and that helps because obviously it helps you identify that, okay, I've got quite a fast trend environment. So basically this here is the 1.5 SD, and what would actually happen is you would now be bouncing off there. Can you see, before we were talking about taking entries here, then we talked about slow trend environment, which was taking entries here. Fast trend, can you see? Why is this so important? Because guys, you have to be able to identify this, because imagine you identify it wrong and you identify it as a slow trend environment. Guys, it's not going to come back. It's not going to come back. You're just going to be sitting there. You ain't going to get in the trade, okay? This is why it's so important to identify the rhythm. It's almost like what a market condition within a market condition. It's a type of imbalance. It's just, I cannot stress this enough, because like I said, and I'm going to repeat the point, we'll do it together on the chart. If the market is doing that, why would you be waiting there? Guys, you ain't going to get a trade that day, okay? If the market's doing that and you're trying to take trades here, fine, you might have to take a trade there and get a little bit of drawdown and then go up. But where's probability? Here. Distribution is building value here in this 1.5 region. What does that do? Shifts the probabilities in your favor. Guys, this is probability trading. This is high probability trading. You know, and it's really important, right? You hear about this all the time. Guys talk about, got to be able to identify high probability. They don't have a clue what they're talking about. This is high probability. I'm showing you, backed up by statistics, real market orders, people buying and selling. And I'm just showing you how you get profile shifts, right? Obviously, the high probability is going to be where the transactions are taking place. You don't even need to look at this, right? If the price of an item on eBay suddenly jumps £200-300, and that's where it trades for the next month. So, you know, we talked about iPhones a lot. Say they're £1,000 in January. Whatever reason, Apple has a shortage, whatever, they jump to £1,200. And in February, they're constantly trading at £1,200. Guys, you can sit there and try getting this thing at 1,000. You're not going to get it. You're just going to miss out. It's exactly what's happening here. You've got to understand, where are the market transactions taking place? It's changed. This is why the VWAP is crucial, and why I say don't treat it as an indicator. You've got to almost think of it from a abstract, intangible perspective. Don't think of it as a line. Almost, I know it sounds crazy, but almost try to be the VWAP. Try to be one with it, and almost understand how these market orders are developing and what is it trying to tell you. And I understand you're not going to get that in one section. You can see why this thing is difficult, why you know, and I'm being frank with you. You've paid for professional education, professional advice. I've got to give you the truth. That's why the failure rate is so high, because people find this difficult. I know it's difficult, but I do believe a lot of that is because they don't understand it properly, A, and B, they don't give it the observation time needed. You know, it's going to take you time. You're going to have to look at 1,000 charts. I'm not going to lie to you. You have to keep looking. It's going to drive you nuts. You're going to be, oh, I don't get this. I do get it. I don't know. Yes, no. It's going to be all over the place until it just clicks. Then you'll be like, oh, I get it now. I understand as the volume profile's building. Because what it is, you know, I don't need to think I'm just talking for the sake of it. It's not. When I'm trading, you're going to see this on my chart. Initially, when I introduce you to VWAP, I'm not going to have this because it's going to be too confusing for me to show you composite profile, VWAP developing as we combine it with the balance and imbalance condition on composite profile. That's already two different perspectives of value: intraday dynamic value and static value of the past few days. I'm combining. It's going to be too much if I start to also introduce this. But as you'll see, I very much look at all the VWAPs: day, week, month, quarter, yearly, etc. I look at composite profiles. I look at weekly, monthly volume profile, and I look at daily profiles. So I'm looking at so many things, but that's because I understand the evolution. And what it is I like to use this in combination with this. And that, my point is, the reason I'm telling you all of this is because I want you to understand it's a process. You're going to have to develop. As you see this thing forming, there's no book, there's no me, there's no one who can tell you, guys, this is what happens when this happens. No, you're going to have to observe it. You're going to become, I hope you can see I'm taking you 95% of the way there. I'm giving you the understanding, the tools, everything you need. But that extra bit of understanding, I can't give you that. You have to observe it. You have to watch this profile of nothing and then build more, and watch how the shape of VWAP and the bands change as the profile changes, etc. Oh yeah, rhythms changed. I'm going to do this. I'm going to do that. Do you see? It's so dynamic. The market is incredibly dynamic, and it's changing all the time. And this is why I always say to people, you know, the market will give you clues even after you enter a trade. You're never going to be successful thinking this is the perfect entry and this is where I exit, and no, it's not going to work. You know, I've said this before many times, and we'll talk about this. Don't worry, it's the last thing I'm going to say is where people set targets, right? Imagine we have just a normal sort of trend, right? And you've got your target up here. Then suddenly there's a shift and the market starts to do that, right? And the rhythm goes from a normal to a fast. You know, you've got to make a decision. Actually, let me move my target higher because market's telling me it's about to go exponential. I'm getting loads of volume being built here. Do you see? It's very dynamic. Whereas when you entered, did you know this was going to happen? This is why it's ludicrous when people say to you, you know, have fixed targets when you're trading value like this. You're going to learn to become a really, really good investor or a trader if you can give yourself the time you need to observe this. I thought I just wanted to say that because I didn't want people to look at it. I know the pace has been really fast and it's been a lot of stuff in the last two, the theory section and then this, where I know a lot of you might have been like overwhelmed, and I just want to give you, you know, a little bit of heart and a little bit of confidence that look, don't worry, it's going to take time to develop, but if you do it properly, the opportunity is amazing. So, you know, I think enough said about that. You know, we'll see how you develop, obviously, over the next few months applying this stuff. There's obviously still a bit left of the pro course, so, you know, we can talk about that later. So what I want to do is I just want to talk to you about very briefly different, essentially, I call them market conditions, obviously, but within days, investors typically call them day types, but you can apply it to weekly, monthly. That's why I don't like that word day types, but fine, I'll use the word because it's what's used in institutional circles. But just remember, just because I say day type doesn't mean it doesn't apply to week, month, year, quarter, year, etc. So let's go and look at these day types and it'll become clear what I'm talking about. Okay, so look, again, just only because I've told you it's a day, do you know this is a day type? Remember, this could be, you know, week, month, quarter, year type. Don't, you'll see when we go to look at weekly VWAP, monthly, quarterly, yearly, etc. It's exactly the same. You know, we're gonna have balance, we're gonna have imbalance. So we've already covered balance and imbalance, right? Balance and imbalance are very different. What I want you to do now is, and again, don't worry, I'm going to summarize this for you. I've got a table which is on the final slide of this that I want you to print out when you're doing this. I want you to get on the charts, which we're going to do together now anyway, and we start identifying these types. Okay, we'll call them day types for now, but they're not, because it's important when we go to weekly, monthly, quarterly, yearly. I told you you're going to be doing exactly the same thing. Okay, and obviously I'm not going to keep covering the same thing again and again. When we go to weekly VWAP, I'm going to say, guys, weekly VWAP is imbalanced. It's got a fast trend or it's got a slow trend imbalance. Because I've already talked about it on the day, I'm just going to apply it to the week and just assume you got it. But the point is that, look, the types of day types I want you to identify really these are the main ones that I think most institutional guys that I knew, you'll see in the books they have loads, and honestly, it's a load of rubbish. I mean, end of the day, you know, if you're gonna start confusing yourself, if you look for very specific types, it's very broad, okay? It's very rough. Just have the basic types, and you'll do fine. And you'll see what I mean by this, okay? Because really, the market can only do four things. That's what I've done here. Yeah, there's variations of this, and like I say, I see it in books where people try to get too, you know, accurate with these type of things. And problem with that is when something that you're too accurate and it doesn't happen, either it just causes you to freeze and you don't take the opportunity that's occurring, or you just don't recognize it because you're so obsessed with, no, the book told me that. Guys, let's keep it basic, and you'll see why I say that. Just stick to these four base types, and let's see in this task if you can identify them. So balance and imbalance, I want you to identify those. You can do them. But what it is there's also reversal. And reversal is essentially starts off as an imbalance, okay? It's an extension. Can you see imbalance? Look. So very much the market was imbalanced, right? We just talked about this. It's above. The rhythm changed. It went from a slow imbalance to quite a fast imbalance, right? So this is actually a really good example of a fast imbalance. Can you see here? I want you to identify these type of things. Just get used to it. Rhythm of the imbalance, rhythm of the balance. We talked about it, second standard deviation. So here you would say, oh, I see, yeah, what Envy's saying. We kind of started off as a slow imbalance, then we shifted gears and we went to fast imbalance. But the point is this type, what happened? Can you see something changed, essentially? See the rhythm changed here? Look, started to fail. We didn't know, right? It could have just continued as a, could have just shifted and gone to what? More of a normal trend, the first standard deviation, but it didn't. It broke aggressively. You can see how aggressively it broke, guys. Obviously the market recognizes, so you saw a ton of sales coming in, and when I've got you watching order flow, you'll see on the depth of market or on the cumulative delta, it would just go whoosh. A lot of people got stopped out or exited here, algos or whatever. The point is not that, it's a reversal day, okay? Reversal week or whatever you want to call it. What that means is that the imbalance is changed, and we've essentially gone from an imbalance, right, market, balanced market, to a balanced market. Look, see that? Imbalance to balance. Can you see that? So that's all reversal day is. In the books, they'll come out with all these 15 different sort of variations. It's all nonsense. It's basically, keep it simple, in my opinion. Okay? It's worked for me my whole career, is because what it is, it keeps me loose enough to think about things when things aren't perfectly fitted. It's okay, it's loose. I can use a loose variation of it. So I hope that one's clear. So I want you to start to identify where the imbalance breaks down, essentially. So we're imbalanced for the day. Okay, see, it's very rough. I don't care about this being very accurate. It's rough. We had a fast trend imbalance. Something changed. Yeah. So the way that, and we'll come much more onto this, the way that this can be traded is, obviously, if you recognize something has changed, probably in this region, because we built some value and then essentially, here, would have built a little bit of value and we broke. You can either just exit your long, or you can get short here. Okay, and I've got names for these. We'll come back to those, but I just want you to recognize that the trading opportunity is a long, maybe get stopped out, do nothing, recognize it breaks, and we're going into a reversal day. oh, we might be going back into balance. So you get short here into a balance environment. Take the trade back to VWAP. I talked a bit about this, taking the trade back to the point of control in the composites. What it is we're gonna very much combine this. So you might have a multi-day composite with your contextual levels that you've been drawing. Okay, so you can see you can have huge confluence here as it breaks. You're coming inside static composite, and don't worry, we're going to talk a lot about this when we combine the two things you've been doing at the end of stage one, and obviously here you're doing in this task. Combine it all and you'll see the power of different investor perspectives, because remember, this is a day perspective. You know, algos, whatever, are doing this. These are going to be longer term investors who see opportunity as we come back into composite value, right? Into this composite value, and we can combine the two. So, you know, all investors are now on the same page, and we'll talk more about this. That's where you identify opportunity, and that's true confluence. So look, I've talked a lot about reversal, where we're going from imbalance to balance, right? What about the other way around, where we go from balance to imbalance? Okay, guys, you've heard this term breakout. Guys, forget about all these head and shoulder breakouts and this rubbish. This is true breakout, basically, where you're going from balance to imbalance, right? Obviously, at some stage, the market has to transition. We talked a lot about this, from balance to imbalance. So essentially, think about it. So early in the morning, right, you're going to say, yeah, we've got this kind of rhythm here and market condition, which is what? Balance, right? But hang on, what's happened here? We've broken down. So here you would be doing what? Fading the market, 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 right? Usual balance. Here you might have faded the market, and then in this region, can you see we're building a lot of value? So you might have got stopped out or whatever. You see, this isn't normal. We're building so much value here. Where? In the first standard deviation. So what's happening is what? Rather than maintaining a balanced profile, look, can you see we're starting to build out volume here? This is the standard deviation, 1SD. Can you see it there? Got to be able to identify this. Hang on, something's changed here. Something is changing. Because you see here, when we came up, we didn't continue to build volume here, did we? We came back very quickly. As I showed you in the depth of market, how we trade mean reversion, we mean reverted. But you see, every time we tried to mean revert, failed. Mean revert, failed. And actually built volume. As soon as we came out of this region, boom, the market just collapsed. Okay, so that's a proper breakout where you go from balance to imbalance. And at the end of the day, you've got obviously two things you can be doing here, and that is, you know, as with here, where you can exit your imbalance trade, here you can exit your fade trade. You know, you might have tried to fade it here, and then you recognize, all right, I'm in trouble here. Take the stop, and then try to either just call it a day, or obviously try to get in when you identify that we've essentially gone imbalanced and we've got a breakout. Okay, so you know, guys, those are the day types, and like I said, I'm going to show you in a second. On the next slide, you've got the everything summarized for you. But essentially, what I want you to do now, we're going to do it together. I think this has gone on long enough, so I'll probably do this as a slightly separate section. Is I'm going to get on the charts. I don't know which market yet, maybe a bit of both, maybe just one, and together we're going to identify all of this stuff. So we're going to identify obviously balance, imbalance, reversal, breakout, but then also we're going to identify the rhythm, right? So for balance, it could be first or second standard deviation, obviously, with the balance rhythm. And then with the imbalance rhythm, straightforward, right? We're just going to do the slow trend, which is either like it's building value above VWAP or the 0.5 standard deviation, or it's building value in a normal trend above the first standard deviation, and or a fast trend, where obviously we're building value at a much quicker pace, right? So the VWAP is quite steep. Normal trend is fairly decent, and a slow trend will just do that. And so yeah, that's what we're gonna do. Let's just quickly look at the summary table, and that's the end of the section. Okay, so there you can see the summary table and trade plan. Guys, I want you to print this out now. Maybe you can go through it with me when I do the video, and I'm going to look at the same way I did lots of composites. I'm not necessarily going to do a whole year, but I'll see how much I do. It's quite late at night now. I'm going to go to sleep and see how I feel in the morning, and I'll basically identify loads of these with you. The same way that you did the composite, I then in this task want you to just go through and identify. And I hope, look, at the end of the day, I used to trade the dome on its own. That's why I did live trades on the dome and stuff like that. I didn't just sit here taking trades of VWAP. That's ludicrous. Of course not. At one stage, I'm going to show you my chart. That's why I just want you to do the scrolling, rather than taking trades of it for now. Don't do that, because that's not how I trade, right? I don't just sit here looking at a day VWAP, one chart, and just taking trades of that. No. It's one of about 12 different investor perspectives. So it doesn't make sense. When the time's right, yeah, I'll show you my full prep and stuff like that. But now's not the time. I'm building you up towards that, okay? I'm sure you appreciate that. You don't want me to just throw 13 different investor perspectives at you. It's going to be too much for you guys. So let's build it up one by one, which does involve you having to build profiles, go back, scrolling, do a lot of like scroll back type of work, and it's fine. It's good for you, okay? See it for what it is. It's really, really good. It will develop your understanding in a non-trading environment. Then you can really build it without pressure and stuff. So print this off. Okay, so we're going to go through, like I said on the previous page, the balanced environment. We're going to try and identify that. I want you to identify that. I already said, the way that you would trade it is obviously fading the extremes, typically the second standard deviation, imbalanced, and actually I want you to, I've put your market condition and rhythm, and actually I want you to identify the rhythm here as well. Even though I haven't put it here, I do want you to confirm the rhythm in a balanced environment. Then we've got imbalanced, again, confirm the rhythm, mention that, fast trend, normal trend, first standard deviation, 1.5 on the fast. Slow trend is 0.5 stroke VWAP, okay? And then the reversal days, obviously, where we go from imbalance to balance, which I've also mentioned. And then, I've already talked about this. You can exit your imbalance trade, or you can initiate on the break, basically, of that rhythm, going back into balance. Okay, and then finally it's the breakout, which is just really doing the opposite. So you've got your balance. Again, identify the rhythm even here on a reversal day, because you may have started off in fact you would have started off right imbalanced, and I'm happy for you to call it trend if you want. It's fine, because I do call it that when I talk about the rhythm. Identify the rhythm, start early in the day as well, and here as well. And then this is where the balance fails, and you've got your options. Exit the range, fade the 2SD fade at loss, and if you can, get in on the breakout like we already discussed. All right, I hope that was really helpful for you. That's pretty much VWAP covered. We're now going to get very, very practical with VWAP, and obviously we're going to look at it. So what we'll do is we'll do that, and then I'll probably talk to you as it stands. Probably just need to cover off obviously acceptance, because I talked about rhythm a lot, and then we'll basically try and combine everything that we've learned so far, and then obviously consolidate, and then essentially, yeah, there's a few bits and bobs left, like with the other VWAPs, and looking at different investor perspectives, bringing them in. But yeah, great job so far. I'll see you when we go onto the charts. Cheers, guys.